Have you been watching the markets lately and wondering what the Federal Reserve will do next? For months, investors, homeowners, and everyday consumers alike have been caught in a whirlwind of rising interest rates, inflation worries, and economic uncertainty. Every announcement from the Fed sends ripples through the stock market, mortgage rates, and even the cost of everyday loans. Now, investment. The big question on everyone's mind is whether the era of rate hikes is finally ending, and if rate cuts are just around the corner. Understanding the Fed's next move isn't just for economists or traders. It directly impacts your finances, your investments, and the opportunities available to grow your wealth. Today, we're going to break down what the Fed is watching investment, how inflation and market trends influence their decisions, and most importantly, what you can do to position your money ahead of these potential rate cuts. By the end of this discussion, you'll have a clear picture of the current economic landscape and actionable strategies to navigate it wisely right now. The Federal Reserve is in a position where every decision is under intense scrutiny because the economy is in a delicate balance. Over the past year, we've seen a series of interest rate hikes aimed at reigning in inflation, and these moves have impacted almost every corner of the economy. Higher rates make borrowing more expensive for consumers and businesses alike. Mortgages have climbed, car loans are pricier, and companies face higher costs when taking on debt to expand or invest. At the same time, these hikes have started to slow certain sectors, cooling off spending and investment, which is exactly what the Fed wanted to do to temper inflation. But the challenge is that economic growth is slowing, and the labor market, though still strong, investment shows signs of stress in certain areas. The Fed has to weigh these competing pressures, tighten too much, and they risk stalling the economy or even triggering a recession ease too soon, and inflation could spike again. Beyond the headline numbers, the Fed also looks at subtler indicators like consumer confidence, wage growth, and supply chain pressures. Investment. These factors help them judge whether inflationary forces are temporary or persistent. For anyone paying attention to personal finances or investing, understanding this mindset is crucial. The Fed's decisions directly influence loan rates, mortgage payments, and even stock market trends. By grasping the current policy context, you can anticipate potential shifts in interest rates and adjust your financial decisions, whether that's refinancing a loan, reallocating investments, or simply preparing for changes in borrowing costs. Inflation remains the central factor shaping the Fed's decisions, and it's not just the overall inflation rate that matters. Investors and policymakers pay close attention to core inflation, which strips out volatile items like food and energy. While headline inflation has shown signs of cooling from the peaks we saw last year, core inflation is sticking at levels that keep the Fed cautious. Investment. Persistent inflation indicates that underlying price pressures are still present in the economy, whether it's rising wages, supply chain constraints, or increased demand in certain sectors. Markets react almost instantly to these signals. When inflation data comes in hotter than expected, investors often anticipate further rate hikes, which can send stock prices down and push bond yields higher. Conversely, if inflation cools more than expected, it fuels speculation that rate cuts could be on the horizon, driving equities higher and lowering borrowing costs. And treasury yields and mortgage rates are particularly sensitive because they directly reflect expectations of Fed policy. For consumers, this means that everything from home loans to car financing and credit card interest rates is affected by inflation trends and market reactions. For investors, understanding these dynamics allows you to anticipate market swings and position your portfolio strategically. Being aware of inflation trends also helps with timing purchases or investment moves. The key takeaway is that inflation is not just a number reported in the news. It's the primary lens through which the Fed, markets, and consumers all make decisions. Staying informed about these trends puts you in a position to act proactively rather than reactively. The potential for rate cuts carries significant implications for both consumers and investors, and understanding these effects can help you plan strategically. For consumers, lower interest rates generally mean borrowing becomes cheaper. Mortgages, car loans, and personal loans can all drop in cost. Investment, which can free up monthly cash flow and make larger purchases more accessible. This can be especially impactful for those looking to buy a home or refinance an existing mortgage. investment, as even a small drop in rates can translate into substantial savings over time. For investors, rate cuts often act as a catalyst for equity markets. When borrowing costs decrease, companies can invest and expand more easily, which tends to boost earnings and drive stock prices higher. This is why stock markets often rally in anticipation of rate cuts. However, not all investments benefit equally. Fixed income instruments, like bonds and savings accounts, tend to offer lower returns when rates decline, which makes timing and diversification crucial. Investment. The key is understanding that rate cuts don't happen in isolation. They influence the entire financial ecosystem. Your ability to anticipate these changes allows you to take action ahead of the curve. Whether that's locking in lower mortgage rates, relocating investments to growth sectors, or adjusting your savings strategy. Importantly, rate cuts also signal broader economic intentions. The Fed uses them to stimulate spending and investment, which can encourage job growth and consumer confidence. By keeping an eye on Fed signals and understanding how rate cuts ripple through markets and personal finances, you can position yourself to benefit rather than being caught off guard when these policy shifts occur. Positioning your money ahead of potential Fed rate cuts requires a combination of strategy, awareness, and proactive planning. The first step is evaluating your debt. High interest loans, credit cards, or adjustable rate mortgages can become expensive if rates remain high. So paying down these obligations or locking in a fixed rate before cuts arrive can save significant money. Next, investment. Consider opportunities to refinance major loans, particularly mortgages. Even a small drop in interest rates can translate into hundreds or thousands of dollars saved over the life of a loan. Investment, freeing up cash for investments or other priorities. For investors, sector selection becomes crucial. Industries like technology, real estate, and consumer discretionary often benefit when borrowing costs decrease, while other areas such as cash, heavy fixed income instruments may offer lower returns in a lower rate environment. Diversification remains key. Balancing growth-focused investments with stable investment income-generating assets can help you navigate uncertainty. Maintaining liquidity is also critical. Economic shifts often occur unexpectedly, and having an emergency fund ensures that you can take advantage of opportunities or cover unexpected expenses without liquidating investments at inopportune times. Finally, staying informed about Fed communications and inflation data and market trends allows you to act proactively. Understanding not just what the Fed announces, but the rationale behind their decisions provides a major advantage in timing your moves. Ultimately, investment. Positioning your finances ahead of rate cuts isn't about speculation. It's about creating flexibility, reducing unnecessary costs, and strategically allocating resources so that when the Fed acts, you are prepared to benefit rather than react. Smart planning today can translate into tangible financial gains tomorrow.